Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking the time to sit with me here as we take a look at not only where we've been so far here in 2023, but what we anticipate for the balance of the year and perhaps even taking a peek into 2024 as well. I want to be respectful of your time, so as always, I'm going to go ahead and jump right in. As I mentioned here a few moments ago, we are moving through this year quickly. We are already into the fourth quarter, just concluded the third quarter here a couple of days ago, so we are rapidly approaching the end of this calendar year. So it's a good time to be taking a look at things. Those of you who receive quarterly statements are going to receive those statements here over the next week or two. Obviously, if you get a monthly statement, it's going to come to you in the normal ways here in the next month or two. But let's take a look about where we've been and then where we are and maybe a little bit about where we're going. First of all, in terms of where we've been, market-wise, as measured by our most popular stock indexes, it was pretty hot in the first part of the year, specifically looking at equities. It was pretty hot as measured by most stock indexes to start the year, hot in a positive kind of way. Cooled off really after the end of July, and so if you look at where, let's just say the S&P 500 index, very often used as a measure of where the market is, the S&P 500 index since the end of July until the end of the third quarter, so about 2 months of performance, down about 7% or negative about 7%. So definitely some cooling off. That's obviously not representative of every holding, of every stock, but definitely some cooling off in the overall market. And especially when we're looking at the parts of the market which have been the hottest this year, hottest in a positive way. Looking at the kinds of things like technology, specifically semiconductor companies or artificial intelligence, AI-focused companies, which really were leading the pack here for most of the year. Those tend to be the ones that you see that have pulled back the most as well. Very common for us to see that when the market takes a breather. So again, the kind of phenomenon with which we're familiar and should be familiar to you as well in terms of market experience. While that's been happening, we've been also seeing some level of what we call market rotation. Now what that means is, generally speaking, that those things that were leading tend to move a little bit further back, and some of the things that were in the back tend to come a little bit closer to the front in leading the markets. We've seen a little bit of that. Specifically, I'm looking at oil and energy companies. The price of oil here over the last several weeks, almost about the same time that the more aggressive technology sectors were pulling back. Price of oil has moved positive over 10% during that time, as measured by the West Texas Intermediate and also overseas Brent crude spot pricing. So when we see those kinds of things, because they definitely lagged in the first part of this year, also want to look at financials and pharmaceuticals, more towards the value end of the market, if you will. Definitely folks taking more of a look at those kinds of sectors now in terms of performance. It looks like, at least in the very short run here, what we could generally consider to be a market rotation. Now, does that mean that that's where it's going to continue to go? No way for us to know for sure. A big factor in that mix, Federal Reserve, as the Federal Reserve has been a very large factor in the mix, certainly here over the last year and a half, as they've raised interest rates from a practical zero to between 5.25 and 5.5%. So a huge amount of movement here in the last year and a half. A lot of different ramifications for that. We'll touch on a couple more of those here briefly, but specifically when we're looking at what we expect from the markets here for the balance of the year, we expect that we're going to continue to see rates rise. As the Federal Reserve has indicated, as of their last meeting, even though they didn't raise rates again at their last meeting here a couple of weeks ago, probably they're going to raise again before the end of this calendar year. So we're anticipating that here, and we're watching what that means relative to the markets. It appears that the markets, generally speaking, are anticipating that there will be one more raise before the end of the year. So you're going to see that affect everything from mortgages and car loans to CD rates, savings rates, all of those kinds of things that we've been seeing here over the last year or so as they have adjusted higher. And that's a big deal. Not so great if you're looking to get a line of credit or you have a balance on a credit card or you're looking to apply for a mortgage, but it's a lot better in terms of looking at things like CDs or high yield savings accounts, which have really just re-blossomed here over the last several months as compared to the literally previous 15 years where rates have been so low, and you know this if you invest in CDs or keep money in savings, rates have been so low that it's been almost a bad joke to think about them. So it's been good to see that, been good to see the opportunities that are there, and we anticipate that at least for the near run, that's going to continue. So let me stretch out a little bit looking into the fourth quarter and then into 2024. In the fourth quarter, we anticipate that things are going to continue to be turbulent. Not because we see anything from either geopolitical aspects or macroeconomic aspects which are unnaturally unnerving, but rather because we're still in a period of adjustment and transition to this much higher interest rate environment as an economy. As I mentioned, it's good if you're in CDs or savings, not so good if you're getting a mortgage, not so good if you're getting an auto loan. So we're watching the real estate and automobile markets to see how far they're going to slow down. We anticipate that they're going to slow down, not in every market and certainly not in every instance, but we anticipate overall that they're going to start to slow down a little bit. So what does that mean in terms of the overall economy? You know, as a previous listener to my updates, that generally speaking, consumer spending between 2/3 and 3/4 of our overall GDP. So how the consumer spends is a big, big deal. Lump into that federal student loans, those loans which have been literally on deferment for the last 3.5 years, those payments for everybody that has a federal student loan are starting again literally as of the time of this recording. What's that going to mean as far as consumer spending is concerned? Well, if there is a brand new spending need specifically to address federal student loans, and on average looks like $400 to $500 per month per person, that's on average. You're going to have some that are above, some that are below that, but on average about $400 to $500 per month. Well, that's money that they would have spent in restaurants or as a car payment or for vacation or other kinds of mostly discretionary spending perhaps, or maybe they upgraded their apartment or got a bigger mortgage in order to be able to take advantage of that free cash flow from 3.5 years ago. Well, now that's coming due. So we're going to watch very closely what that means to consumer spending. Again, no red flashing lights at this point, but definitely we have some concern, especially as we're looking at the Christmas retail season, which tends to be a pretty good barometer of consumer sentiment. Meaning that as folks feel more confident, they tend to spend more money. So if we see that the Christmas shopping season or retail season cool off compared to last year or previous years, that will also be some level of an indicator about where the consumer is and perhaps where the overall economy is as well. Now, in a positive light, because I feel like I've talked about several negatives here, in a positive light, the unemployment numbers continue to be very, very low. I would offer up even too low, and it's not because I want anybody to lose a job or for anybody to not be employed in the ways that they want to be employed, but from a very academic standpoint, we need a certain amount of unemployment in the system, in our $30 trillion plus system, in order to balance the marketplace. It seems a little bit counterintuitive, I know, but it actually makes good economic sense to always have a certain number of folks who are looking for different kinds of job opportunities. So we're looking at that very closely as well, because generally speaking, when interest rates are rising, unemployment rises as well. If you think about it, rates rising, more expensive for companies to do business. If they're looking to cut expenses, one of the fastest ways they can do that is by cutting headcount or by cutting their employee base. So we tend to see unemployment rise. We haven't seen that to this point. I'll raise my hand quickly and say I thought we would. Actually well before this point, but we haven't. So we're watching it closely to see what kind of reasons, what reasons may be the case for that kind of thing happening, and then is it just more of a lagging sort of expectation that we can see coming down the road, and then what that means for the overall economy as well. So again, looking into the fourth quarter, we're very cautious. We think things may continue to be a little bit noisy. We're watching very closely the kinds of movements that will happen with the Christmas retail season, not because that's the only marker, but because that tends to be one that, again, is indicative of where the consumer is feeling comfortable or not comfortable in spending. So we're watching those things very closely. Going into 2024 then, it's going to be the election season. It's going to be noisy in so many ways. We're a little bit cautious about what we see coming into 2024. The economy at that point, as we get 6 to 9 months beyond the end of the raising cycle by the Federal Reserve, tends to set up the new normal, meaning in terms of how the consumer is spending, how real estate is moving, how cars are moving in terms of buys and sells, and what that means as far as overall consumer sentiment is concerned. So we will probably see in Q1, maybe even into Q2 of 2024, where the new normal is for the economy. So we're watching that very closely as well, because it is different, and we're probably going to be, I had this conversation just before I jumped on to the video here with a client, we're probably going to be in an interest rate environment which is going to be higher for longer, meaning those ultra low interest rates that we saw for a decade and a half, we're probably not going to see those for at least some time, some measure of time, longer than months, we're thinking years. If at all, that's going to come back. So we're watching to see what that means as far as economic growth is concerned. Does that slow certain things down? Does it present some new opportunities in places that maybe for the last decade or decade and a half haven't been as good of an opportunity? So that's what we're watching going into that space. Well, friends, I appreciate you taking the time here and allowing me to drone on a little bit about the kinds of things that I'm seeing and that our team is seeing here about where we are and where we anticipate where we're going to be. You're going to hear from me again in Q4, definitely with an update. Certainly if something moves in a very quick or unexpected kind of way, as always, you will hear from us. But as you know, at any time, for any reason, you want to reach out, set up some time together in person, set up a Zoom call, a phone call, just to chat about either what's happening in your end of the world or about what's happening economically with your portfolio. Should we make some tweaks based upon where things are moving right now? I always enjoy hearing from you, and I would enjoy that a lot. But in the meantime, I think it's pumpkin spice season. At least that's what my daughters tell me. At pumpkin spice, I tend to see folks, they're either in a love relationship with it or a hate relationship with it. It's still kind of fun. It is the fall season. We're starting to see the colors change in certain parts of the country, so it really is beautiful to be outside, again, in many parts of the country. And I hope that this is an enjoyable season for you as well, especially because, as you know, I love football season. So even though our Pittsburgh Steelers and our Carolina Panthers are suffering, those are my two teams. Neither one of them doing real well right now, but we can hope for good things depending upon what comes next. Well, friends, again, I appreciate so much your time and your willingness to be a part of this. Always, always, always. Feel free to reach out as it's good for you. And until that next time, I'll look forward to chatting with you soon.